Hi there, and you're watching Dukascopy TV for a look at the Philippines with Ed Jones from World Economics London. Now, Ed, at its latest meeting, the Philippines raised its benchmark interest rate for a second consecutive meeting. Now, this is its very first tightening cycle since 2011 in an attempt to fight inflation. Ed, do you think tomorrow's inflation figures will cause the bank to shift towards a consensus view of tightening at the next meeting on October 23rd?
It's possible that they may raise rates again, but it's important that they don't overreact and try to take a measured approach. As with a lot of things in life, timing is key, and if you do too much too often, then you could end up with unforeseen consequences. In the September SMI for the Philippines, World Economics noted that the wholesale price inflation between August and September came down by quite a margin. World Economics tracks the prices in a wide range of industry sectors for goods and services, and on the whole, inflation has been starting to ease recently. Now may be a good time for the central bank to stand back, see if the recent rate rises have had the preferred effect, and then make further judgment calls in the coming months. The annual average rate of inflation in the Philippines is around 4%, which is the target set by the central bank, and a long way from the 6 or 7% average seen over the past 10 or 15 years. Our indicators suggest that prices are starting to cool from a very high level in the summer, so on balance I would personally adopt a wait-and-see approach for the next few months.
And according to your latest report, Ed, future business confidence is very high and market growth continues to rise. Can you tell us more about these findings?
Over the past 15 years, the Filipino economy has been growing at a really solid pace and is currently seeing a growth rate of around 6.4%. All sectors of the Filipino economy are expanding at a rapid pace, and it's only natural that businesses are feeling confident by the current market expansion. But they are also saying that future business conditions are looking very positive. The Philippines has a special relationship with the United States of America, and this is sure to be helping. Unfortunately, the Philippines are located in an area of the world which is regularly impacted by natural disasters such as Typhoon Haiyan late last year. It's a credit to the Philippines economy. It's very resilient and bounces back quite quickly in these situations. All the major indicators from World Economics, and indeed the Reuters Business Sentiment reports, are all saying the same. Business confidence in the Philippines really is at an all-time high, and this is being driven by solid market growth and real improvements in the lives of a large segment of the population.
And Ed, your report also looks at the fall in payrolls. Now, what is your outlook for the labour market this year?
Up until June, the growth in payrolls was extremely strong. It started to slow in July, and that trend has continued through to September. It's important to note that this is a slowing in the growth rather than an overall contraction. It's hard to predict the future with any certainty, but we believe that payrolls will start to pick up pace again over the next few months. This will mainly be driven by strong market growth, high demand, and the exceptionally high business confidence we just spoke about.
And the Philippine peso ended a fifth week of declines. This is the longest losing streak since January. Ed, are you concerned that a rise in US rates will spark outflows from emerging markets?
It's a trend that we've seen recently in a number of emerging and frontier markets. Mongolia, for example, has been hit terribly hard by a lack of foreign direct investment and the appreciation of the Turkic against the US dollar. The Philippines has a much larger and more robust economy than Mongolia, but the concerning trend in the decline of the peso needs to be watched. It will have an impact on the price of imports, and that brings us back to the level of inflation that the people on the street are seeing. I'm sure that the concerns caused by the potential rise in US rates will probably be worse than the lasting effects once they do.
Ed, thank you very much for your time today. While viewers, do not go anywhere, do stay tuned as we have plenty more interviews and economic updates heading your way. See you very soon.